In the last lecture, I forgot to switch that on. If you see that I haven't switched it on, it would be very kind if you could remember if I forget, but I don't make you responsible. So, okay, I think we have understood the meaning of nominal value, of nominal cash flows. Maybe coming back here, so we said book value is equal nominal value plus premium discount. So this here, and all these cash flows here, they drive nominal value. So that is what driving nominal value. Plus then on top premium discount, but in this example it was 0. So now we go a step further and we ask ourselves, yeah, how does now premium discount kick into the game? Now this I do with a more simple contract. I take, what kind of contract? Oh, should I switch that off? Manuel. I think it's better, huh? Now, what kind of contract do we have here? What contract type? Now, this one you should get. Beside the discount paper, the next simple one. It's a principal at maturity, PAM. Because you get all the principal. So a simple pattern. You pay out once, you get back everything, plus some interest. So this is a classical PAM. So we will do now all the different bookkeeping rules along this contract. So the contract is always the same, but the valuation will be different. So it starts like this. So we pay out, say, something like 80. And we will get back 100. So that means it's something like buying a government bond where you have a discount of 20 on it. So you pay 80 for the bond, and you will get 100 back in 1, 2, 3, 4 years, say, if that is annual payment. So we have 4 interest payments here, and the principal. And now we are at the bookkeeping rule nominal value. It's also called write-off at beginning. Before, the first example was also nominal value because there was no premium discount at the beginning. So nominal value was always equal to book value because like the nominal value principle, if that was assumed there. But here we start with a premium discount of 20 or minus 20 if we go the other direction. So the value is at the beginning 80. So if we now want to have nominal value, what do we have to do? You know, we pay 80. What would you book? Now think like a bookkeeper. It would be bonds against cash. So that your cash is drawn, your bond portfolio goes up. And how much would you pay? What would be the number which you would book? Are there some bookkeepers here? So what would be the number? 80. Because that is what you pay for the bond. Simple. Okay, but we know we are going to get back 100. So what is the nominal value of it? 100. Because the future cash flow is 100. We are looking into the future, so the nominal value is really 100. So now if you say the bookkeeping principle is 100, so how much do we have to book at the end of the day? 100 somehow. It should show like 100. So what do I have to do with the 20? What is the 20? That's the premium discount which we have to write off. And how do we do that? How do we write off the premium discount? Now all the bookkeepers, I think there are not too many among you, but so much you have to know. What do you do with this premium discount? What do you book it against? Income. So you would let's say you treat it as interest income. So you would have value change. So in the value on the bond, you would book 20 more against interest income. That's what you would book. And this you see down here in the lower picture. So this gray area, this is the interest income which is reflected by this accrual. So it's actually the first derivation of that accrual is this line here. So you accrue interest every day. So like, say, I'm making the simple example. We have a bond of 100, and we have interest rate of 12 to keep it really simple. And now, so how much would be the income on that bond per annum? 12. So 100 times 12. Okay, so but now accrual, what does accrual? It cuts this 12 into time pieces. You say, I get, actually the 12 you will get as a cash flow here. Here you don't get anything. But still you want to see income. Let's say you want to see monthly income. So what would be your monthly income? Taking the example, it's quite obvious. So everybody can do the math here. So you have 12 annual income, so monthly income will be 1. So nothing else what the accrual is doing here. It goes from 0 to 1 to 2 to 3 to 4. Or you earn 1 here, 1 here, 1 here, 1 here. That's basically what you do. So then the income is the first derivation against the accrual. The nominal income, the gray, it's a straight line. So because it's a thing. And these jumps you don't see. You can, so here there's no derivation at this point, and so it continues like that. So, and this part here creates this additional income. And so that means you will have a big income on the first month, and then you have just the nominal income. So that's how it works together. So that's nominal value. Is that clear? Okay. So let's go to the next. Amortized costs. Now that's a little bit more difficult. Who has heard already the term amortized costs? Could you? No? Okay, that's of the two bookkeeping rules in IFRS, this is the second important one, besides net present value or market value. So amortized cost has the rule that the income over time here must be a constant. So here this is a time between 2 points in time, and so this is the income over value. So what is income over value, by the way? Income divided by value of a bond. What is income divided by value of the bond? That's the rate. That's the rate. And of course here it's a book rate. So we have to take premium discount into account. So it makes it a little bit more difficult. If there is no premium discount, it's easy. So here it's a book rate. So, but this rule says nothing else, that the income rate of that bond must be a constant. But the problem we face here is if I go back to this example, here, how do I have to handle this over time? That it becomes a constant. That's the problem we have to solve. So how do we have to move, what is the trajectory of PD? That this PD plus this nominal interest here, down here, divided by the value, which is then itself a trajectory of that PD, that becomes a constant. And the rate which returns that constant, that then gives us the amortized cost. Coming back here, To get that, we have to solve this equation. And I think this equation must somehow be familiar to you. Somebody ringing a bell here? Look, you say the value, what we say here, is these are the future cash flows, all cash flows, including interest cash flows, minus this is the current value which I pay. Here, this is the current value which I pay to that, and that discounted, the future cash flows discounted, must be equal to 0. Or in other words said, that what I pay for it, and I choose the rate of all future cash flows such that it becomes equal to my investment. And that is what the internal rate of return says. And I think internal rate of return, is that something, who has heard the internal rate of return? Now show. Okay, I'm very happy. so there, yeah, okay. So that's internal rate of return. So it's the same formula here. So that means you get amortized cost if you can decide the internal rate of return. And then write off the PD according to the internal rate of return. So that's the general rule. And that's how it looks like. And actually, this is the exact graph. You see it's a little bit bumpy. And actually this, one of my colleagues, Rami Entin, he did all the nice graphs. And he, of course, programmed them perfectly. So that's the programmed graph here of that function. So why is it a little bit bumpy here? You know, it goes like that. The reason is because the accruals are constant linear. You know, and to make the accruals linear is a little bit artificial, so you have to correct that in the PD. The whole thing is then, if you would take the accrual into account on total, it would make a nice exponential function. But you mix two things, like something linear and exponential, which has to be in total exponential, so then one thing has to correct that. So, but you see now here, the value, so here we have the nominal income, like before. That's the same. So that just derives from here. And now the premium discount is just the difference between 100 and here, and it goes up here, and it increases here. And if you would derive at any point in time that income which you make here from here to here, which includes the accrual plus the value change, divided by that value, which I have up there, you get a constant. So you get always a constant rate. Because take the other case. Now we will come back to that. But this is amortized cost. And it's based on this formula. It's an internal rate of return formula. For me, it's always a little bit miraculous, I must say. So really to understand it, I had to do the calculation sometimes in an Excel sheet, and I saw it's true. So, and it's probably the mathematicians have a good proof for it, why it is. And it's true under all circumstances. We had complex cases, you know, and we had to solve all these cases in the software, and we spent months, if not years, for all the complex cases, you know, which showed up, and we had to solve. Okay, that's amortized cost. Now, historical value and write-off at the end, that's very simple. That means you keep the, oh, sorry, it should be switched off. Okay. Historical value write-off at the end. So that means you take the deal in here for this value, and you keep it at this value. We took it in at 80, so we don't write it off, that premium discount, as we did at the beginning. So the value is always, and you see the nominal income is like that. So what you do then with the premium discount in this case, and by looking at the picture, you should figure it out. And also looking at the name, should tell you. So what do we do with premium discount in this case? Because we have it at 80, 80, 80 in the books. And I get my income regularly every year. And now at the end, Now let's say we are 1 day before maturity. So I have it at 80 in the box. And tomorrow what will I get? How much will I get? $100, the full amount. So now how would you book that? You have now, on the books, you have 80 of the bonds. So, and then you get now a notional. So if you would do cash against bonds, so you would have 80 and then suddenly you 100. You would have, because you get 100, you have a problem with the 20. So you would have lingering around 20 in your balance sheet all the time, although the bond is gone. The bond is gone and still 20 would be lingering around in your balance sheet. What do you do then? You have to recognize those 20 as income. It's the same like before. Before we just did it at the beginning. Now we do it at the end. So you do then something like bonds against interest income 20. And it would be cleared. Because one rule of bookkeeping is when the thing is gone, the value must be zero. So there cannot be lingering any value in the balance sheet after you have done that. You see, bookkeeping can be quite interesting as well. So it's good to see what happens there. So the rest is the same like in the nominal value. Now mark to market, fair value. I drew a line here. Let's assume the market value is going down first and then going up. Of course, in reality, it will do something like that. But I don't want to make it so complicated. So we just made a little mathematical function. So the value, I bought it for 80. The value drops to 78, 75, and then it goes up again and goes automatically towards 100. Actually, market values will always tend towards 100. Why should the market value go automatically in direction 100? Why is that real law? Assuming there's a good credit, no default, so that's guaranteed, but it's a bond. And why should the market value tend to 100 all the time? Anybody a clue? Because assume you are now 1 day before maturity. How much are you going to pay for that bond? Independent almost of the interest rate. 100, because you will get 100 tomorrow plus that little 1 day accrual. And that doesn't matter, you know, what the rate is. Maybe you pay 99.9, whatever. But on the day, it must go to 100 because you get 100. Yeah, because for 100, you pay 100. So nobody pays really more for that. So once cash for cash. So that's the normal rule. So that's why it will always tend to 100. That's clear, given no default. Okay, so let's assume this is the trajectory. So what happens to the nominal income? What happens to nominal income under all bookkeeping rules? It's the same. So nominal is depends only on the hard cash flows. But what happens to premium discount? You see here. So why is it negative first? And then it gets less and less negative here. Here it becomes zero. You can take that as the zero line here, because I add it on top of the nominal value. And then why does it become positive? What would you say? You as mathematicians should see that right away. So how are the two functions related? One is the derivation of the other. We said it's the delta premium discount. The change, the income is the change of the premium discount. So the lower is the derivation of the upper. And that is what it is. The income, it's the same what we did with nominal and historical value. The change, how did we have to book it? The change of value? What was the bookkeeping statement against what type of, how did you book it? Against income. So the delta premium discount was income. The same thing here as well, but now in small pieces. Every day a little bit. So you like your book every day. So the change and so on, you add it up. And you get that. So you have a low income at the beginning, of course. You have a low income because you lose. The value is getting less. And then at this point, you see it turns, it's zero. So you neither lose nor gain. And now it's catching up again, you gain. That's exactly what bookkeeping is doing. It moves the things over time from the premium discount perspective. Yet here, we are talking now about net fair value and market value. And we have to be clear yet about terms: market value, mark-to-market, fair value, and NPV. So when you look into the Neue Zürcher Zeitung or Reuters or whatever, and you look at the column market value of a bond, which value will you get there? What number will you see there? Has everybody studied a little bit bond markets and so on? So what do you get there, the number? Yeah, minus accruals. So the accruals, that part is separate. So you have to be careful. So you get the market value itself is minus those accruals, and you get the rest, but you get the accruals too, just in a separate calculation. You know, people like to make it complicated, but it's that. So be careful. So you get the two, and it's then a percentage at the end of the day. So observed market value is without accruals. So you have to be careful. It's not equal what you normally calculate when you do an NPV calculation. Because in the NPV calculation, you have the current accruals included. Actually, you have the next cash flow included discounted. So it doesn't go exactly like accruals. You know, it goes a little bit around that. Yeah, clean price, I think they call it. That's the X accrual. Yeah, exactly, clean price. Yeah, and dirty price, yeah, NPV is dirty. I would rather call it the other way around, but that's how it is. So you have to be careful. You could make bad business if you wouldn't know that. Significant. And fair value, the term fair value corresponds to market value of non-observable, non-market observable contracts. So where would you calculate fair value? For example, in all the deals which you have on your balance sheet, which are not traded. There you do normally fair value calculation. So, but what you do, you take similar conditions like in the market, generate your cash flows, and deduct the value. And then, of course, it's always a question, did you model the conditions well enough? That's always the question. And these are problems you might be able to solve during your examples. Yeah, the accrual is the difference between market value and NPV. Okay. Now the last one of the big four is linear write-off. Now that looks simple. So we write off this additional income equally over time. That's easy to calculate, and you see we get here now a straight line. That's just the additional income which we get every day. But what would happen to the rate here? You know, before we had this accrued, the amortized cost thing, and the condition there was to get a constant rate. So when we divided that income by the value up there, what would happen to the rate here? Can somebody tell me? So you divide income by value. Excuse me? Yeah, it will decrease. Because you divide first by 80, the same income, which you divide then by 100 later. So the rate would decrease in this case. So that tells you also the reason why amortized cost is so. Amortized cost does it more fair, you could say. So it's the equal income power, because the income is relative to the value, and therefore that's why it's more taken. Now, law of cost of market, that's not anymore part of the IFRS, but still you might find that in local GAAP. I think in Germany it's still allowed, and it was used a lot before, because so the bookkeepers were proud on that, meaning, so they said we never, we don't show too much profit. Show profit as late as possible, which wasn't a bad thing actually. So like Enron did show profit before it was there. Actually, profit which would never come at the end of the day. So I think that the traditional bookkeeper is more sound than those rocket scientists who advised Enron. But anyway, so at the moment it's not fashion, but just for you to understand. So this line here is still the evolution of the market value, like before. So law of cost of market means we follow market value as long as it's below what I paid. So I follow market value down here. I'm losing because now the value is less. I still follow up here because it's still less. I don't follow market here anymore because that's what I paid. And now just take the first derivation. So it breaks here and it makes a little jump here because you write off that part at the end. Okay, good to know. At the moment, not too much in favor. It might come back. Sometimes old fashions do come back. And minimum value is even more strict. It says book as long as the value is going down, but never book higher than what you ever booked before. So we write off here because it's going down. Here we stop, and we never write it up again until the end, where then we make a bigger profit. But what I want to tell you, once you have understood that in terms of premium discount and so on, I think it becomes easy. You could invent any crazy rule now and just think in these terms. And you are the best bookkeeper. So it's much easier than to think about these things if you think in these terms. Yeah, then I mentioned already, in the crisis, suddenly those net present value fans turned away from net present value, and they said, we want to have now more fair is expect the cash flow based value. Of course, it was more fair to them because the national banks would pay more for their stinky assets. So what they did, they forecast the cash flows. Yes, they took a little bit the higher discount rate, but not the one which you should take to be on market value. So they got more for the assets, and now they let the national banks breathe it out and see they can collect now the cash flows, for the next 20 or 30 years. And maybe they are lucky and they will get it back, and maybe not, and they will get it less back. So it's a trick, and I think it's a bad trick. That shows also all these heroes of net present values. What it is at the end of the day, it's, come on, I want to have my pocket a little bit bigger. That's everything. Yeah. It's a hidden present for the too big to fail banks. And I think I even never saw a critical article in any newspaper that the real gift was this offloading the debt to the national banks. Oh, did you see one? Did everyone? No. People didn't realize it, thought it was like value against value, which it wasn't. Okay, so that was now the value over time. We looked at value over time depending inside one currency. So all what we did so far, we were in currency. So let's say we were in Switzerland, we made a Swiss franc deal, so FX doesn't play a role. Now, what happens if you have now a deal in another currency? So the FX rate kicks in as well. So you need now a bookkeeping rule for the FX rate. So the bookkeeping rule for the FX rate is independent of the bookkeeping rules. Actually, there are two rules, and I haven't seen in practice any other. You could invent more, but in practice I saw only the last years, and actually IFRS allows only these two, but even without IFRS it was true. So let's call it fee. And the one is mark to market and the other is historic cost. So what you have to do is now multiply the value. Now it's bookkeeping rule beta, that's inside currency, comma, FX, bookkeeping rule, phi. So the FX follows phi, the rule phi. If that is mark to market, so you have every day a little bit up and down, and you book that. And if it's historical, then this is constant. And the value, in currency, it can follow any other rule. It could be mark to market, so then both is mark to market. But it's well possible that the in currency rule is amortized cost, and the FX rule is mark to market. Or the inside rule is mark to market and the FX historical. Would be a little bit unusual, I must say. Often then you have both mark to market. So, and the total value change is given by the value change due to FX rate and the value change inside due to the bookkeeping rule it has in itself. So these are then the two components, and there's again a little cross-section which you have to make sure what you allocate to what. Now there's a third thing which you have to account for. So far we assumed there is no credit risk. So we got all the cash flows which were expected. So now we have to write off for expected loss, so impairment, credit risk. So you model credit risk by adding a second premium discount here. Say the IFRS, call it the net interest income IFRS, because they demand it, of course. So you have the nominal value, that's still the same, that's derived from the cash flows itself. Then you have a premium discount which reflects the normal premium discount, which reflects the market conditions. And then you have a credit risk premium discount section, which reflects the expected loss on the notional cash flows. So those cash flows which you have to write off because you will not get them. Well, maybe going back here, yeah, something like that. So you assume that part of that cash flow you will not get. Of course, in reality, you will get some you won't get, and some you will get, and some you will get half, maybe. But because you don't know exactly which one you won't get, so you make a write-off on every of the class, of the same class. Is that clear? But just simple pieces, huh? So it's little Legos. It's not really difficult, but you have to have the categories right. And that's good. It's really helpful. So it will help you to understand bookkeeping also much better. So there are other things yet. Operational, I will not even touch here. Investments, because we are not in that. Yeah, coming to IFRS 3239, so we have only 4 bookkeeping rules. And we spoke already about the critique on fair value bookkeeping. Let's not go back. But now here I have a nice case. You know, IFRS, that's related yet that you group your financial contracts. I think there are 4 categories. One is held for trading, to trading. One is an intermediate position where you could go to trading. And one is held to maturity. There's another one. I don't exactly remember at the moment. So you have to say, this part of the balance sheet is really trading. And let's only look at two sections. This one is trading, and this one is really held to maturity. What does held to maturity mean? You never sell the deal. No, you just get the income, and then at the end you get the cash flows. That is what banks normally do, actually, if they do not securitize and sell it off. Now, in Switzerland, most banks still act like that. So you have your deal, and you end it, and you make a new deal. So that's held for maturity. So, but now with IFRS, if you are in one of these 4 categories, that determines the bookkeeping rule which you have to take. If you are in the trading section, if you say trading, held for trading, or trading, just trading. So what is the bookkeeping rule you have to assume there? Most likely, Make a guess. Yeah, mark to market, huh? Because the traders, they are mark to market, huh? And it's true. You have to sell it tomorrow. That's what you get. Huh? So you write off every day, and so you always you don't get any additional surprise when you have to sell it. So there it's mark to market. And held for trading is the other side. So that is amortized cost. So and then there are intermediate cases where you can switch and do crazy things. So you have to go into the book. I knew it once. It's really complicated, and you have to know the steps. So bookkeepers know that. But now you can switch between the two regimes. Now, if you switch, and here is the case where we had it first held to maturity, and that means we planned not to sell it, and then we changed the status into mark to market. That means on the way, you change the bookkeeping rule, halfway of the deal. So that happens here. So we started with the deal here, and it was held to maturity, so we follow the amortized cost pattern. So we have the trajectory of amortized cost. And it was here as well. And then on this day, we shifted it and did it into the trading portfolio. Now, first of all, on that day, will the market value be equal to my book value? Yes or no? I went first the amortized cost trajectory. And now comes the day where I change it and say I want to hold it for trading. Now what would you expect with the market value? Would it be equal to book value or not? And most likely it will not be. It will be anywhere. Because I was following a mathematical trajectory. And that will most likely not be equal to what happened in the market. So that because the mathematical trajectory was only time dependent, not market dependent. So, okay, so we will have a difference of market value on the day when we do it, and on the book value as I have it on the book. And this is this delta here. The delta, which you see here. Now you have to treat that delta specially. One way would be to write it off immediately. But that you cannot do. You have to store it, and to write off that part, still amortized cost. So this little piece here is amortized cost. You see it here, like getting slimmer, and but it does a little bit like that. So you keep that, and that goes amortized cost. So you have to keep all the effective rate, the internal rate of return, everything is going there, and it's going to zero. At the same time, look, this is the real market value up here, and the market value fluctuates like that, say. So what we do is this part is amortized cost, but now this fluctuation minus what is written off an amortized cost is added to that, plus the amortized cost. So you end up there. So you have two movements. There's premium discount which you create on the day when you shift. You write that off amortized cost, plus the movements which you have real, so you move then along the black line. Again, if you think in premium discounts and so on, you can handle it. And so we handle it for big banks. And it works fantastic. If you have once all the information about the contract, it is you just make sure that you keep all the little pieces of premium discounts. You must link it to the contract. And then people can go back and forth. So you keep on all the pieces of premium discount which you still have to write off over time. Okay, that's just, that will not be a question on your test. So, I mean, maybe the rough questions, yes, but not in detail. You don't need to know exactly how that works. But it's interesting to know how it works in principle. Now, if you are in IFRS 30, so it's 3239. 3239, by the way, is the financial part. IFRS is a big thing. It covers the right of machinery and all that, the full bookkeeping. And 32, 39, they are responsible for financial instruments. That's why banks are really concerned with 32, 39 here. And then you can do hedge accounting. So you could have something which you hold on your portfolio, and because you have hedged it, the hedge itself would be mark to market. But the thing which you have on the portfolio could be amortized cost. So that would create artificial value or income swings. Why? Because the hedge is mark to market. The other thing is relatively tame, and you sum it together, you get a swing. But why did you hedge? Just to avoid that swing. If you would treat both instruments fair value or mark to market, the two swings, the two movements what would they do? If it's a true hedge, they would cancel out. And actually they do almost. Why only almost? Because the world is never fully perfect. You hedge with something which is similar to that, and the movements, they might differ a little bit, etc. So that's why if you do a hedge, you have to prove that the hedge is good. And how do you prove that the hedge is good? By looking at the value of the hedge and of the market value of the hedged item. And if they do basically this, then it's good. And if they don't do that, then it's bad. So there is a hedge test which says that you have to be, I think, 90%. It has to be 90% correct. But what the 90% means, they never defined. So you can do it in many different ways. But one way is highly accepted is to take the R square. What do you do here? This is the value of the hedge, and this is the value of the hedged item. And you can do, you look at the value changes. So you plot the value changes of, let's say, the hedged item here, and the value of the hedge here. And if it would be a perfect hedge, what would we expect? How should the two values, the value change of a hedged item and of the hedge, if you plot them on an XY diagram, and if it's a perfect hedge, what would you expect? Yeah, equal. Huh? It must be on a straight line. By the way, there is an error here in our plot. Because it's the way we calculated the values. What would be the slope of the line? And who finds the error? What is the slope expected? 1, yeah? Almost correct. Now 1, you would say what we said here in the picture. Now the error has to do with the 1, because you expect if it goes up, it goes down, -1. So it should actually, that's the error here. But it's not really an error, because it's the question how you measure these things. We turned it the way around, but it would have been better not to turn it around, because it's really positive and negative. So that's the question. So what you really would expect is -1. Now, just to give you a little bit an insight what happens in bank then. So, for example, at Bayerische Landesbank, they use the system to hedge their positions. So we took the hedge item, and then we made simulations. So we made simulations, and they took 36 scenarios, like interest rates going up high, low, and FX rates changing if the FX played a role, etc. So 36 scenarios. Then they forecasted the value change of the hedge and the value change of the hedged item. And then it should cancel each other out. And if the 36 scenarios all were within the 95 percentile of the R square, They said it's a good hedge. And then, after this, they had to do the real hedge testing, them looking at the value changes. And they had, almost in all cases, they never had to unwind. Where other banks who did a much sloppier approach, then they thought it was a hedge, then it wasn't, then you have to unwind, and then you do all the bookkeeping, as I showed you before. So such a system can help you very much because you can do all the forecasting and say, okay, under all strange position, it should hedge out. Okay, we declare it. They hardly had to declare anything. Yeah, we are a little bit running late. I should be. Okay, but yeah, we do it like this. So take your break because it's good to ventilate the brain a little bit. Come to the problem of income. So everything what we said now was value. And we saw that, no, there was a little income like the nominal income and the change of value. Yeah, we looked at that. But now we really look at income. And especially we look at the problem of funds transfer pricing, FTP. Now, this is not a filed transfer protocol, so the same name is used for that, but FTP is commonly used in banks for funds transfer pricing. So what is the meaning of funds transfer pricing? It's actually a necessary condition to do profitability. And I guess you have heard about like customer profitability, profit center profitability, and things like product profitability, etc. So knowing how profitable is this customer, or this profit center, this branch, etc. And to do so, we have to introduce like a bank in a bank. So that's what you basically do. And let's assume now we have a very simple bank. We have just 2 profit centers, and we are interested in profit center profitability. But the same approach works then for any profitability. This is just an example and easy to explain. So one profit center is the asset profit center, and the other one the liability profit center. These are the 2 deal-making profit centers. So whenever you get a loan from a bank, you go to the asset profit center. Whenever you do a saving account, etc., you go to the liability profit center. So to see how profitable, for example, the assets are, we cannot take just the income on the assets. Let's say we have a rate of 5% on the assets. So, and we have 100 assets. So could we consider the 5 which we make every year, could that be income? I mean profit, it's income for sure. But could that be the profit of the asset profit center? And if not, why not? And whoever likes to give an answer here. So why is it not possible to say that the assets make a profit of 5? So we have a balance sheet of 100. The income rate on the asset side is 5%. So the income is really 5. So why can't we say the asset profit center makes a profit of 5? We have no cost, to keep it simple. Why is that not an answer? Because you cannot make assets if you don't have liabilities. Look at the other guy. If that would be true, that he makes 5 profit, look at the liability guy. What would he make? A loss. Because he has to pay interest. So it would be very clear the liability guys make loss, the profit guys make profits. Then the idea would be, let's do it without liabilities. Can we? No, except you have a lot of equity. So the equity is maybe 5%. So we need 95% liabilities. So you cannot exist you cannot have assets in a bank if you don't have liabilities. So that's the problem. So which we are solving by adding a 3rd profit center. That's the bank in the bank, and that's normally the treasury. So that means the treasury is now the counterparty to any transaction. If the assets make a deal they give a loan, so they get money back, so they themselves make the back-to-back transaction with the treasury. And if the liability gets in money, basically they sell it to the treasury. And the treasurer gives the money to the assets. You can say it also like that. Now, at which condition should they transfer money? What would be the fair condition where you can sell your deals to the treasury or buy it from them? That's a typical problem of transfer pricing. You know, like the same thing happens if you have a firm in another country, you give them steel or you send them parts. So what would be the fair price of those parts? And what is the common answer, especially of economists? They always have only one answer to if it comes to price. The market value. so the price which you would pay in a full functioning market. So what is the market value of the treasurer? And now think only on making bonds or making loans and taking in money on the liability side. So what is the market value? Where would the treasurer find the market value for his deals? Where would that be? It's something like the swap market rate, the swap rate. This is a riskless rate, like the most efficient rate, you know, bulk trading rate. So the swap market, one unencumbered rate, which most likely is a swap rate, that's then the rate the treasurer will work against. And because, of course, this has a term. So that's the idea. So you get in a loan, you get the money from the treasurer. At what rate? On the swap rate. So if it's a 5-year loan, where do you go? To the 5-year point on the swap rate. And the treasurer might take a little thing for his service. That might be on top of it, but generally it's the swap rate. Same thing, you get in a 5-year fixed deposit. So what should he pay? The 5-year rate. Okay. So that's actually the calculation. So you have basically what we calculate with that is what is the Deckungsbeitrag 1, net contribution 1. I think in English the term is not so established. In German it's very much established. No? Deckungsbeitrag 1. That's the raw income which you have without any overhead and so on. Huh? So for your direct, so to cover your own costs and the rest. Huh? So what you do is the interest income. Say on the asset side you made a loan. Say the 5%. You get the 5%. And say at that day when you made the deal, the rate for the same type of tenor was 4%. So what would go to the treasurer, the transfer? 4. So you keep the 1. Huh? So 1 so that's the gross income. So and from there you have then, so that's the income for the asset profit center. And from that the asset profit center has to cover its own cost, which is the second part, which then leads to Deckungsbeitrag 2. So, which means the whole direct cost is now covered. Plus, then there is Deckungsbeitrag 3 when you cover the overhead, the management as well. So that's a transaction. And funds transfer pricing is about Deckungsbeitrag 1. Here, so we get that now closed. If I look at this from a cost accounting perspective, I will keep that short because we said we keep cost out, but still it's interesting. So we have here the contract, and the contract is linked to many things like a profit center, like a counterparty. So the contract belongs to a counterparty. That's for credit risk. This we will cover. Now these we will not do in our models, but it's linked to many things. Here, now we are caring about the profit center. And now you allocate to this contract the cost and the income. So then the net interest income is the gross income, the 5%, minus the 4% which go to the treasurer, plus then the allocated cost. And then if you have done that for every deal, so then you know the profitability of every deal on any day. And now you can go and you can aggregate it as you wish. For example, profit center profitability would be nothing else. Select all deals which belong to that profit center. Look at the income it made from T1 to T2, sum. Or if you are interested in how profitable a dealer is, take the deals belonging to the dealer. Look at the profitability of these deals from T1 to T2, because you know the profitability now every day, if you do it correctly. You know all the little pieces, the delta premium discount, the net interest income, the transfer, which goes away, and we know that from every day. So it becomes really easy to make profitability calculation, and a lot of what banks are doing are profitability calculation. Why are they so interested in such type of calculation? They want to know where they make the buck. And then, so you can push more here, you can push more, you can compare, etc., etc. Okay, that was cost accounting. Now, we do funds transfer pricing not only for cost accounting reason, but also for risk accounting reason. Funds transfer pricing will allow us to separate the income according to source of risk. It's a very interesting thought. So we can separate now how much income we make due to risk and how much we make due to other factors. And now just imagine we are inside one currency and only fixed income. So it's more complicated for other things. But the fixed income problem is the biggest problem actually to solve. And now imagine we are a very simple bank. And we are on an island. And we open the bank right now. And we have no capital. So we start the bank without capital. That makes everything easy. I mean, easy to calculate, maybe not easy to live on that, but the calculation is easier. And because we have no money, so what can we do first? Can we give first a loan, or do we have to wait for somebody giving us something? Of course, we have to wait for a liability business first. And let's say the guy comes and he says, I want to give you 100. And then I will ask him for how long? He will say up to TL. And then I will go to my yield curve and say, okay, this is the rate. This is the rate. Now here we have the interest rate. Okay, you will get this rate for this time. And if you multiply then this rate, this time times the volume of 100 here, that's the expense. So this square you can imagine to be the expense. Here. So then now I have 100 in my cash box. Now I can wait for the first customer to give a loan. And let's assume, also for the simplicity reason, he wants to have a loan of 100. So I take the 100 out of my cash box, and I will ask the guy, for how long do you want to have the loan? And the guy will say, for up to TA. I will check again my yield curve and add the little spread, yes, something like that. And I will say, okay, the rate is this. And again, if you have the volume, and let's say it's 100, so it makes everything is easy. So what we have, the square below this red line here, is the income. Or that's actually the income, and that's the expense. The blue is the expense, because that's a liability side. So on the liability side, we have expense. On the asset side, we have income. Okay. So now I have done the two deals, and I could go to my hammock, because all the money is out. And where is the profit? That's also known. I could already do the books up to, let's say, this is 1 year, maybe, or say this is 1 year. So I could close my book because I have so much income, I have so much expense, and this area here is my profit. And I can go and sleep. Until the day when the guy knocks at the door, the liability guy. So it now we come to TL. And he will rock me out of my hammock and say, hey, I want to have my money back. So now, where is my money? It's fixed. It's given. I don't have money because I have given the 100 away to a loan. So now there are only two ways to do that. And that's what banks do all the time, by the way. So they either you tease the guy to extend the loan. Say, stay with me. Or I get another guy. These are the two possibilities. No other chance. I cannot go to the guy I gave the loan. He said, hey, it's in my house, you know. You want the bricks? No. I want to have the money. So he can pay me only after that time. So I have to wait. So, okay, one way is to tease the guy into the new business, roll over, or getting a new guy. Independent of what it is, let's say we tease the guy into new business. Now we will say to the guy, okay, this is the rate, I mean the new thing. And could I tell him, okay, this will be the rate again? Could I say that? I could try. But now there are two cases. The rate is lower now, you know, because rates have changed over time. So he wants to do the same tenor again, so up to here. And I check up the yield curve, and let's say the rate has risen. Before it was 4%, now the same would be 5%. Could I tease the guy into a 4% deal? He will say, no, you know, I go to another bank, I get 5%. So the only way is to keep him is by paying him 5%. The other way, if the rate went down, would I pay him 4%? No, I would say, oh, now the rate is 3%, so stay with me and 3%. And he will stay with me because that's the best deal he can make. So the others don't offer a better deal here. So we have this situation. The rate can be higher or lower. So what will happen to my profit now? What will happen to the profit? That depends what the rate will be. So if the rate is lower, good. My profit will increase, because now the area will increase. If the rate is lower, then the profit is so much. If the rate is higher, then the profit will be so much. So, okay. So that means now this term mismatch, that will affect my income drastically. And how do we call that? Risk. So now here the risk comes in. Here. And now here this fund transfer pricing is important because we can now measure how much of the income we make due to this risky business. So how much income do we make due to margin taking, and how much do we make due to risk taking? Here. And here the graphic is quite nice. It shows us the two main dimensions of risk. So where do we see the two main dimensions of risk here? So basically this is a square. You know, actually the dashes should have gone straight up. I just wanted to draw it like that. But basically it's a square. So the risk is defined by a square here. So the dimensions are, as you see them, the first dimension is time. So time difference is everything in risk management. You know, matching time or not matching, keeping it open, etc., etc. So time is very important. And you hear it in terms like duration, which are important for risk management of bonds. You know, that measures actually that time somehow. So time is important. So what would be the second dimension here? What could that be? Fluctuation. Yeah, it's standard deviation or risk. The riskiness of the risk factor. And the total riskiness of that bond will be the combination of these two deals, is the combination of the two. So these are the two main items here. Now, of course, we have no FX, etc. With FX, it becomes a little bit more complex, but inside the currency, these are the two main dimensions. So we have sigma r and delta t. So these are the two dimensions of main dimensions of risk. Now, how does that go together with funds transfer pricing? Now, go back to the old story. That was the yield curve here. And the two guys who came, the first actually came this guy here, and say the rate for this term was 4.5%, no, 5%. And because I take in a liability, I will give him a little bit less. That's my spread. So here the spread is 0.5. So I gave him a rate of 4.5%, say. And 5 isn't. So what do I give? What do I get from the treasurer in this case? So the 4.5 is the rate the customer gets. The treasurer gets 5%. Why? That's the fair transfer price of that day. On the very same day, we get the next guy, and he is the asset guy here. And we find, the corresponding rate for the term was 5.6%. And I give him a rate of 6%. That's, my spread is 0.4%, and I get the money from the treasurer for 5.6%, and I give it on for 6, so I get 0.4. So I have two spreads, 0.5% on the liability, 0.4% on the assets, makes 0.9. But if I count 6 minus 4.5, I get 1.5. So what happens with the rest? The treasurer. So that goes to the treasurer. You see, the total margin is 1.5 here. And we have the two sub-margins for the asset profit center, the other one for the liability profit center, and the treasurer gets. Now he gets, in this case, 1.5 minus 0.6. And you could say that's a little bit unfair. The treasurer does almost nothing. You know, he just sits there, one guy maybe, pushing the money back and forth. The other one has to go and convince and do all the work. So why should the treasurer get so much? I would declare it unfair. Is there one of these bankers which we don't like? Now he's only a part of the whole community. What? Why does the treasurer get so much? What could be the answer? He takes the risk. Where is the risk? In the time difference. He could hedge himself away and he would lose actually. If he would make a swap, short against long, what would he have to pay? Exactly that 0.9, I think we calculated, and his profit would be gone. So he will get his profit only if he keeps on the risk, if he doesn't do a hedge. Here. So let's see what happens in the next period. Now we are one period on. And the first deal, the asset deal is still running, still fixed, because I gave it for 5 years or something like that. So we have 4 years left. The first deal is gone. That was 1 year. Now, what happens depends on the yield curve on that day. Let's assume the rate went up. Now this is the new yield curve, this one up here. That's the new yield curve. That was the old yield curve from previous period. Now this is the new. And let's assume he will, again, a guy comes and makes a 1 year deal up to here. So what will be the 1 year rate for that? Will be something up here. That will be the 1 year rate. So here, that's what he will choose. So I will get from the treasurer 5.8 or something like that, and I give it to the deposit holder, say 5.3. As a liability profit center, I make my 0.5 because I'm cheaper, as I give less than the market. But look what happened to the total margin. That has shrunk drastically. But still, the profit center asset makes still his 0.5% or 0.4%. The liability still makes the 0.5, let's say, and the total margin is very little. It's less than the 2. And that is now the treasury margin, which is negative. Why? Because the treasurer took the risk. He was betting, say, on falling rates. The rates went up, he loses. If the rates would have gone down, of course the treasurer would have made good profit. So that shows that if you do a good fund transfer pricing, we can separate income and see how much is risky income, my market risky income, and how much is non-market risk income. You can separate that quite well. Now, within our framework of income and value, now I just go to linear write-off. That's easy to draw. But it works the same for the other methods. So what you have to do is to split, on one hand, the delta prim discount, and on the other hand, the net interest income, into portions relative to what is the outside rate, what is the transfer rate, and what are the spreads then for the single parties. It's a very easy Dreisatz. I don't know how you say that in English. Like, what is Dreisatz in English? You know, one worker takes 5 days, how many take 2 workers? You know, this kind of calculation. It's just proportional to the rate, actually. So that's the way you calculate it. So you calculate net income plus delta premium discount, depending on the bookkeeping, divided by the effective rate. And the effective rate is the rate which we calculated when we did amortized cost. That's that rate multiplied by the transfer part. If we had, before the example, we had 5% outside, and let's say that was also the effective rate. So we had an effective rate of 5%, and we gave 4% to the treasurer. So the treasurer gets 4/5 of everything. It's just a relationship between the 2 rates, actually, but calculated in effective yield terms. It's a little bit more complicated, but it's the same like amortized cost. You can read in the book why this is. There's yet the net present value view. Let's maybe even forget that. What is a difficult issue is funds transfer pricing from non-maturity accounts. Non-maturity accounts are saving accounts, current accounts, mainly. And we said it's a kind of the boring accounts, simple, but if it comes to analysis, they become extremely difficult because they don't have fixed cash flows. And one of the most difficult part is the funds transfer pricing. But I think we will skip this one because I really have to go on and maybe read that in the book here. Because otherwise you don't, actually this was planned only to take 1.5 hours, so now it's 2 hours. Any question here? So if you have got that all, you're a perfect bookkeeper, I tell you. You will beat every traditional bookkeeper. If you keep these principles in mind, it will be much easier to think, especially in a bank. Okay, so we are coming then to the next lecture. Sensitivity. So what we did so far was we looked at value income. Now we go down this branch. And sensitivity is very widely defined. The general definition is the change of value, now given the bookkeeping rule, against the change of any risk factor. And risk factor can be anything. I mean, you often think about market risk factors like interest rates, FX rates, etc., but can be actually the credit rating or the status of the counterparty is a risk factor, or the behavioral parts, which we discussed as well, can be a risk factor. So anything. And if you say sensitivity, we also mean it for higher order derivation. So first and second. Normally that's the way it goes. One like delta gamma, or duration, convexity. So there are two orders, and then you forget it. Doesn't bring too much anymore. So that's what we mean by sensitivity. And the beta is normally, now here always if we talk about sensitivity, it's really mark-to-market. So we restrict ourselves to mark-to-market. There is theoretically also for the other bookkeeping rules, but they will be very jumpy and often non-dependent. For example, what is the sensitivity of amortized cost against interest rates? You can tell it offhand. What would you expect? The first derivation of amortized cost method, we saw that, against interest rates, market interest rates. You should say it out of your head. It's zero, because it's only time sensitive. If you go to the formula, you will see. So you calculate an internal rate of return, but that's not the market rate. That's only the rate which returns you a constant income. So it's fully independent of market conditions. So the first derivation is zero. And by the way, that's the way you should try to learn to think, not too much in formulas, but really feel, what's going on, and then you can think much better in derivations in an intuitive way. So it's that will help you to understand what reacts on what and what is sensitive and what not. Okay. Good. So that's why we look only at market value sensitivities here in this case, and there it makes also sense a lot. If you are exposed, if you have a portfolio, you really need to know how sensitive you are to a risk factor, because that will affect the value of tomorrow, and that will most likely be a value which you have to sell for. So from that, it's... Now, there is a big problem with sensitivities that often we don't have analytical solutions, because life is really more complicated than often what we can do with formulas. So here I have a list where sensitivities works, where we do have analytical solutions in general. List is not fully complete, but it gives you about the framework. First of all, it works only for standard contract types without non-maturity contract types, only for maturity contract types. Non-maturity were just the types I discussed before, saving account, current account. It doesn't really work there. And definitely not an analytical solution, because there is a lot of behavioral elements behind. Then it works only if there is a clear functional dependence between market conditions and the conditions on the contract. Like, for example, a variable rate bond, if you have a spread, say it's LIBOR plus, then there's a straight connection between the cash flows of the bond and the rate. It's the rate times plus the spread times that. So then you have a clear formula, and that you can derive. So that is possible. So these are the factors. So if you have behavioral functions included, normally we do not have a derivation, because the behavior can be anything, and you don't know beforehand. So there is no derivation. So the only two behavioral elements where the derivation should work now, especially also in risk pro, is credit default and mortality rate. That's for insurance contract, because there's an easy relationship, and then you can calculate. And the valuation principle really only mark to market on a fair value basis. If you don't have that, which is often the case, we calculate it with the hand formula. So we follow this formula here. We take the risk factor as position, we move it up once, and we look at the value. We move it down once, and look at the value, and we take the difference between the two values, and you get the derivation. So it's the hand-made derivation which works all the time. And for security, you have to do that. By the way, that's one of the ways we function, we check the correctness of RiskPro. That was one, that we always derived by formula where we could, and did that. So if we gave the same, we were pretty sure it's the same. And it's very hard to get the same. So many things you have to, each thing affects the formula. So if, in most cases, the derivation doesn't work, so why do we bother with analytical derivations? The reason is it's calculation efficiency. It's much faster, much better, and still there is a wide application. The conditions are often given that the derivation exists, and often these derivations are used for limit management or using it as limits. For example, the delta of options is used, to manage your exposure, or the duration of bonds, duration of the portfolio is used as a limit measure. So still it's good to have analytical solutions wherever we can. We come to the first sensitivity, which is interest rate sensitivity. And now that's not that easy because we have a yield curve. And the whole thing can move. So you're not sensitive necessarily against one risk factor, but against many. If you have a bond, let's say a 5-year bond with 5-year with annual rate, annual interest payments, and we just start to how many points of the yield curve are you sensitive? To 5. Because you have a cash flow every year. And you are sensitive, each of those cash flows is sensitive to the rate corresponding. And then you must be careful today, because we just started, the cash flow is out 1 year. Tomorrow, the same cash flow is out 364 days. And the day after tomorrow, 363 days. So whenever you measure, the thing has to be very clever to find out against which rate you are sensitive. Of course, and once we have contract types well installed, that happens automatically, because you always know what is the term to that, to any cash flow which you have to look at. So these are the risk factors you are exposed to, and as many cash flows you have, the more you are exposed to. And the value, you can see, is nothing else than these cash flows. And now let's assume if it's a fixed bond, it's easy. Then the cash flows are known, discounted by the risk factors. And the simplest of this is the duration measure, which you probably all have heard about, which is nothing else than deriving this here against R. But now, what is the assumption behind duration? If you look at here, if you especially look at this formula and compare it to what we said up here. Here you are reduced to 1 R. Actually, what you assume is a parallel shift in the yield curve. You go along the path, where each variable changes the same. So that's the assumption behind duration. Now, does it make a bad measure, duration? Because we assume that, assuming that each point of the yield curve moves the same, means parallel movement of the yield curve. Is it a bad measure? No, it's still a good measure. The reason is because about 80–90% of the movements are parallel. If you do a component analysis, it's about 85–90%, which is a parallel movement. And only then you have a turning and a bending, which makes 10%, maybe all in all, or 15%. So the management of the parallel shift is the most important management. But you have to be careful, especially when you have high rates, when the likelihood that the yield curve turns, so then the duration is a bad measurement. Because turning, it doesn't measure. It really measures only the parallel thing. And we have to do better measurements. Duration has very nice interpretations. You can also say it's the average time to repricing, because we have so many cash flows and events, so it's not so simple, but you can imagine it like the average time to repricing. And that's why if it's a zero bond, what is the duration of a zero bond? Maturity, because it will reprice at maturity. That's easy to. But if you have a bond with high coupon, it moves it to the present. For example, a 30-year US mortgage, even without call, if there is no call, the duration. Who has a guess for the duration of a 30-year? Roughly speaking, it depends yet on the rate. It's about 30 years to maturity, and it's amortizing. The duration is about 10. So very far away from 20. Be careful. Huh? Why? Because not only we have interest payments, but also principal payments, which come early. Huh? And that's why you have a lot of average repricing, which is close to now. Another definition is the immunization horizon. That's an interesting one. The following happens. If, let's say we have now a bond for 100, and let's say 10-year bond, and the interest rate drops, what will happen to the bond? The market rate drops. It's a fixed bond, and the market rate drops, value will go up, depending on the duration. If it's a long-term bond, it goes up, and so on. So what will happen to that? Now, let's assume, again, simplicity-wise, the yield conditions, the interest rates stay constant over the whole time now. So it just makes up and constant. What will happen to the premium discount? It will go to zero. It will be zero at the end of the day, we found out, because at that day you get the cash flow, no premium discount anymore. At the same time, but there is a counter effect. During the time, this is a coupon-bearing bond, you will get coupons. And what can you do with the coupons? You can reinvest them. And now, what did we say about the rate? It's lower. So you reinvest those coupons at lower rates. So you have a positive effect of the value, which becomes less and less, and you have a negative on the income, which becomes more and more. And there is a time where they equal out. I don't know whether I exactly matched the right point, but they should be equal on top and on the minimum, on the low. And where they equal out, that's the duration. So that's why if you have a 5-year bond with a duration of 4, you are not immunized for 5 years, but for 4 years. So if you want to have a portfolio where you will know your income, you have to choose the right duration and not the right maturity. And that can be very different. If you do it with zero coupon bond, it's the same, because you don't have the reinvestment problem. If you don't have zero coupons, it's not the same. And it can be drastically different, as we saw in the mortgage case. Well, that's the duration. Okay, then there is yet the idea of key rate duration. We said before, in duration, we assume the parallel shift of the yield curve. Now, key rate duration fixes that problem a little bit, roughly, but it's a good approximation, by segmenting the cash flows according to time slots. So here we have the time slots, here. And I segment them, and now this is the yield curve, and now if I shift it here higher than that, so we have now a non-parallel shift, and this shift will affect those cash flows. And this shift will affect these cash flows. So you segment by term of the cash flow, and then you make a non-parallel shift, and then you can calculate the effect on the non-parallel conditions. So this you have to do in times when you have to expect turning of yield curves. So then duration will not be a good measure. So, and that's a good, it's also a rough approximation, but it covers 90% of what you want to see, which is probably often enough. Yeah, now here, maybe I let you calculate that at home again, but this is now a constant maturity swap. And that's the trick is you reprice on, let's say, every quarter, but you reprice, say, on a 5-year rate. And here's the trick. Because when you reprice on a quarter and you do normal discounting, you assume you will reinvest again in a quarter. But here we reinvest in 5 years or in the other thing. Now here, just a little trick here. That shows you really the problem. So we have here, that is the first notional, and this is the first interest payment, which is known. So that's fixed. So this, and we are at the point of analysis here, and this is the yield curve. And these are the points which are necessary, and here this we can discount normally. And at this point we reset the rate, but not on T2, not from here to here, but from here to here. So that's why we have here T3. So, and that determines actually that cash flow, because the rate which you will calculate is depending on this T3, because it's a longer term. So the next cash flow will depend on T3. And that is again discounted by T0, T2. So that gives you the solution why it's so more complex. But here you see also a little bit by when you enter this in RiskPro, the only thing you do, you enter data. And that is the mechanism you do in the background, because then the system has to understand all that and figure it out correctly. And that's done for you. But it's good if you understand also what happens in the background. And these kind of questions could be questions you have to be able to at least explain. Not the formula exactly, so, but even that. Okay. Thank you very much. Sorry for bothering you for 3 full hours, but Jonas was not here. Otherwise, he would have made it a little bit more equal. Thank you very much for listening. Thank you.